All right, thanks for joining me for another term sheet teardown. Today we're going to talk about valuation caps, specifically those related to safes or convertible notes. Before we dive into that, my quick disclaimer, this is not legal advice. Hopefully it's helpful, but really this is just for entertainment and educational purposes only. Go get a good attorney. That's my number one tip for founders that are starting a company, is to make sure you do your docs right by working with a really good startup attorney. All right, so let's talk about valuation caps, why they matter, why you should be thinking about them, both as an investor as well as an entrepreneur. So valuation caps show up in safes and convertible notes. Now, why would you raise a safe or a convertible note? Well, you do it because it's fast, it's cheap, and they're both fairly well-known instruments for raising capital, particularly when you don't know what the valuation is. And that's important because today we're going to talk about valuation caps, which in a way are like an implied valuation on the company, but for convertible notes and safes. And so if you're thinking about this, you should be already asking yourself, like, well, if I'm doing this because I want to kick the can down the road on valuation, but I'm kind of putting a value on the business today, doesn't that kind of defeat the purpose? And there are a lot of VCs, like people like Mark Suster, that would say, yeah, it does kind of defeat the purpose. You should just do a price round. But, there's still a lot of reasons to kind of kick the can down the road on valuation, and a valuation cap at least gives you some buffer around setting that valuation today. So let's go through this. In a safe or convertible note, investors will make an investment, and at some future date, that investment, that capital that they put in, will convert from debt or from the safe agreement into equity. A safe actually stands for a simple agreement for future equity. It's kind of like this. It's not really debt. It's more like a contract where it's like, I'm going to give you some money, and then this contract is going to dictate how this money works. But at some point, I want it to become equity because I want to participate in the upside. And a convertible note is like, hey, I give you this money and it's debt, and you're going to pay me like interest, but not like in cash. You're just going to, give me more shares at a fixed interest rate. But at some future date, again, I want it to convert from debt into equity. Like, I really want to participate in the upside of the business. And that's why you invest in these things. So you have these valuation caps. And a valuation cap at its core is like, in the future, when my investment in the safe or the convertible note converts into equity, I need to know what valuation it's gonna convert at. And it basically says that the investment that I make will convert into equity at no more than this valuation. That's the cap part. By the way, it could also be a floor. I've done deals, I'm a little bit embarrassed to say, but I've done deals where it was actually a floor, like this investment won't convert at anything less than this valuation, right? If you think that through, that's basically like a company that has a lot of power in the negotiation, where they basically say, you know what, we're such a cool company, we won't take your money for less than this valuation. It could convert at more, and that's really to our benefit, but we're not taking a hit on this to let you into the deal. And sometimes you have to do that for really hot deals. So let's do some quick math. This is really simple. So let's say you invest in a safe, and that safe comes with a $20 million valuation cap. Well, let's say you invest $1 million into the company. Well, in the future, so let's say fast forward into the future, you have one of basically, let's call it 3 outcomes. Let's say outcome 1, the company raises a valuation at a pre-money of $30 million, or they raise one at a pre-money of $20 million, or they raise one at a pre-money of $10 million. Okay? So in all of these different instances, our $1 million is going to be treated slightly different. So in this case, at a $30 million valuation, I invested in the safe at a $20 million cap, which means my investment is going to convert at a $20 million pre-money valuation. Okay, so let's run through a simple example. Let's assume that you invest in a safe with a $19 million cap or valuation cap, okay? And so I invest $1 million into that safe, okay? Fast forward, let's say they go on and they raise their Series A round. And in this case, there could be 3 potential outcomes. So outcome number 1, they raise at a $30 million valuation, pre-money. Outcome number 2, they raise at a $19 million pre-money valuation. And number 3, they raise at a $9 million pre-money valuation. Okay, so as we work through the math here, in this case, I'm going to convert my $1 million not at $30 million valuation, but at 19, which means I'm going to own 5% of the company in the pre-money, which is basically calculated by 1 million divided by 20 million post-money. Because this $1 million goes into the $19 million, that gives me a $20 million post. That is my 5%. Okay, but that 5% is now part of this 30 million. So what that means is this 5% is going to be worth $1.5 million, right? Because 5% of the 30 million. Then they're going to raise more money on top of that, right? And I didn't tell you how much they're going to raise, but whatever they raise is going to go on top of that, and then it will dilute my ownership down a little bit. But you can see already, like, all right, this is awesome. I invested with a cap of $19 million, and so instead of converting it a $30 million valuation, I converted it at 19, and so now my investment is worth $1.5 million before they raise any additional capital. And even if they do, it still is worth that amount. All right, in outcome number 2, they raise it this $19 million pre. Well, the $19 million is the same as the cap, so in that case, I still just end up owning 5% of the company, right? However, in this case, it's not worth the 1.5, it's going to be worth just $1 million because it can be 5% of, in this case, it's going to be $20 million post money because we're going to add in my $1 million, right? Although it could get a little more complicated because it depends on how much additional capital they raise in this round. So let's say they raise $5 million. In that case, then this is going to be worth 4% of the business, right? Because it's going to be, the math here is 1 million divided by $25 million post money. All right, the last example is the company raises at a $9 million valuation, way lower than our cap. Well, in that case, I don't convert at the cap, I convert at the lower valuation. So in this case, I end up owning 10% of the company, right? 1 plus 9 is 10, and then I take my original investment, and that's 1 over 10, so that's 10%. Pretty simple math, right? And my investment is still worth $1 million. Okay, so that's how valuation caps work. You can imagine the reverse for valuation floors. You don't see valuation floors very often, especially in this market. But why would you have a cap, and why does it matter? Well, if you're an entrepreneur, you don't want a cap, right? You want like uncapped convertible notes and safes, and you just want any money to come in, like you can convert into equity at the future, right? Whatever that ends up being, like we're just gonna punt, and you can convert along with any other new investors that come in. But as an investor, you definitely don't want that, because let's say you come into the company and it's really risky and they haven't figured out product market fit, and they don't have a lot of customers, and like you don't know if this thing is going to go out of business tomorrow. If you don't have a cap, then you're not going to enjoy the upside if this thing actually works out and is successful. And in the game of venture capital, it's all about the upside, right? Like you are trying super hard to get as much upside as you can, because the reality is these companies are so risky, most of them are going to go out of business and you're going to lose all of your investment there. So when something does hit it big, you want to generate as huge of a return as you possibly can to make up for all the losses. And so by putting a cap on it, you basically say, okay, you know what? Sure, valuation's hard to like nail down right now, or you want to move fast, you don't want to waste a ton of money and time on lawyers' fees and diligence and so forth. I get it. Let's do a safe or convertible note so you can just get running and get going. But if I'm going to do that, I need a cap. I don't want to invest a bunch of money in the company and then fast forward a year from now, you guys are absolutely crushing it and you raise at like $100 million valuation. And my investment converts at $100 million valuation, right? In that case, it's like, geez, I took all of this risk and I'm being rewarded for taking that risk the same as those investors that waited until the company was already, this successful in order to invest. And that just doesn't feel right and doesn't get most investors really excited. So generally, how do they think about caps and where should caps be? What you'll generally do is you'll look at and see like what's market right now for a typical Series A in your industry, and then kind of marking it down a little bit from there. So if a Series A round, on average is coming in at about a $25 million pre-money valuation, which is in ballpark. The last few years, valuations for Series A, I think, from my perspective, have been in that like $20 million to $50 million range, give or take. So, right now where things are a little more compressed, maybe it's $25 million. Maybe you knock it down a little bit and you say, I'll do a cap of $20 million, right? Something that gives me a little bit of a cap in terms of like, if you just knock it out of the park and you raise it a $50 million valuation, I still get in at like a really low valuation on a comparative basis, but is pretty close if you came in at a $25 million valuation on your Series A, so that you still have, close alignment with those other equity holders. Because one thing that can like get a little bit out of hand is as you add more investors at different valuation levels, they're all going to have different incentives on when they want to exit the business and, what kind of decisions they're pushing for. Like, do we push to go public or do we push to sell the business and get acquired, or how much we want to push on the growth pedal and burn cash or whatever it might be. So especially at the early stages, you want to have like good alignment with the other investors, and being out of whack too much on valuation can cause some issues there. But you definitely still want to get rewarded for the risk you're taking. And so, that's my like general rule of thumb. Earlier stage, of course, like look at seed stage, look at pre-seed valuations that are priced and plan accordingly. If it's a growth stage and you're doing what's called a bridge financing between one round and another, where the company, is running low on funds, but they're really close to hitting a milestone that would create a valuation inflection or a higher valuation. Maybe you look at that and you say, hey, the valuation cap, I want it to be the same as the last round. So sometimes you'll see that, or maybe it's like a marginal increase, or it's somewhere in between like last round and where they think this round's going to end up. I've even seen cases where like, they believe the valuation's here and that's the cap. And so, you get some comfort that you're not going to go above that. And then, like, frankly, there are other mechanisms that I talk about in another video. So be sure to check out my term sheet teardown where I talk about discounts and discount rates as it relates to safes and convertible notes, because that's another mechanism that you can use in conjunction with a valuation cap to offset or to compensate you for some of the risks that you're taking on. Anyways, if that was helpful, check out some of my other term sheet teardowns, like the one where I cover pro-rata and why pro-rata rights end up being super impactful. Thank you.